In 2013, when Netflix executives spoke quietly about becoming something bigger than a streaming platform, few people took the idea seriously. At that time, Netflix was still shaking off its image as a DVD by mail company that had barely survived the collapse of Blockbuster. Meanwhile, HBO represented the absolute peak of prestige television. Shows like Game of Thrones weren't just popular, they defined culture. So when Netflix leadership said their goal was to become HBO faster than HBO could become Netflix, it sounded bold, even unrealistic. Yet, that statement revealed something deeper about how Netflix saw the future of entertainment, not as a collection of channels or studios, but as a single global system driven by data, technology, and scale. That vision didn't emerge overnight. Netflix had already learned a painful lesson years earlier when it tried to sell itself to Blockbuster and was rejected. That rejection forced the company to think differently, not just about distribution, but about control. If Netflix wanted to survive, it couldn't depend on other studios for content forever. It needed ownership, it needed intellectual property, and most importantly, it needed to think long-term in a way traditional media companies often didn't. As the 2010s progressed, Netflix quietly began laying the groundwork. Original content wasn't just about creating shows. It was about learning audience behavior at a global level. Every pause, rewind, and abandoned episode fed into a feedback loop. This wasn't how Hollywood traditionally worked. Studios relied on intuition, experience, and creative risk. Netflix relied on patterns. Over time, those patterns became power, allowing Netflix to predict demand before audiences even knew what they wanted. By the early 2020s, the gap between old media and new media had become impossible to ignore. Traditional studios were still structured around cable networks, theatrical releases, and regional licensing deals. Netflix, by contrast, was borderless. A show released in Los Angeles reached homes in London, Berlin, Sydney, and Toronto on the same day. That global reach didn't just bring subscribers. It reshaped expectations about what entertainment should feel like. So when rumors began to circulate that Netflix was interested in acquiring Warner Brothers, it wasn't just another corporate headline. It felt like a symbolic moment. A company born in the late 1990s, built on envelopes and DVDs, was now in a position to absorb one of the most iconic studios of the 20th century. This wasn't merely a business deal. It was a sign that the balance of power in entertainment had fundamentally shifted. To understand why the idea of Netflix acquiring Warner Brothers feels so unsettling, you have to understand what Warner Brothers represents. Founded in 1923, Warner Brothers isn't just a company. It's a pillar of modern cinema. Its logo has appeared before generations of films, shaping how stories are told and remembered. From classic Hollywood to modern franchises, Warner Brothers helped define what movies and television could be. Over decades, it built a library of characters, worlds, and narratives that became part of shared cultural memory. Through mergers and expansions, especially its 2022 combination with Discovery, Warner Brothers grew into a vast media empire. It came to own brands that touched nearly every corner of entertainment, from DC Comics and Harry Potter's to CNN and Cartoon Network. These weren't just assets, they were ecosystems. Each one carried its own audience, its own creative community, and its own expectations. Managing such a complex organization was never easy, but for much of the 20th century, scale itself was a strength. However, scale became a weakness as the industry changed. Cable television declined. Advertising revenue fragmented. Younger audiences moved online and on demand. Streaming wasn't just another distribution channel. It directly challenged the foundations of how Warner Brothers made money. The launch of HBO Max was meant to be a response, a way to protect legacy content while adapting to new habits. But competing against Netflix required more than a strong brand. It required massive investment, technical infrastructure, and global reach. At the same time, Warner Brothers found itself under financial pressure. Debt from mergers, declining traditional revenues, and the rising cost of content creation all weighed heavily. While Netflix was pouring billions into originals with a clear streaming-first strategy, Warner Brothers was trying to balance old and new worlds simultaneously. That tension created cracks, and in those cracks, acquisition talks began to feel less unthinkable. Netflix, on the other hand, saw Warner Brothers not as a struggling company, but as a treasure chest of intellectual property. Acquiring Warner Brothers would instantly give Netflix decades of storytelling power, production expertise, and prestige. It would also eliminate one of its most respected competitors, HBO. From a strategic perspective, it was almost too logical. But logic in business doesn't always translate to comfort in culture. When the potential deal was finally announced, the reaction was immediate and intense. On paper, the numbers were staggering. An acquisition valued at tens of billions of dollars would place Netflix among the most powerful media entities in history. But beyond the financial scale, the implications were far more complex. Netflix wouldn't just be buying studios and shows. It would be inheriting Hollywood's legacy, along with all its contradictions and conflicts. Netflix framed the acquisition as a win for consumers. More content, deeper libraries, and enhanced viewing options were the official talking points. In the short term, that argument made sense. Subscribers would gain access to legendary franchises and award-winning series under one roof. Convenience would increase. Choice would expand, at least initially. But history suggests that consolidation rarely stops at convenience. Behind the language of optimization and value creation sits a familiar concept: shareholder value. For growth-driven companies like Netflix, there comes a point where subscriber growth slows. When that happens, revenue must be extracted elsewhere. Prices rise, advertising increases, features once included become add-ons. The experience subtly shifts, often without users noticing until it's already happened. There was also the question of jobs. Mergers promise efficiency, but efficiency often means redundancy. Warner Brothers employees had seen this pattern before. Each merger brought waves of restructuring, layoffs, and cost-cutting. Netflix's own projections of billions in savings raised concerns that history would repeat itself. For creative industries, these cuts don't just affect workers. They shape the kinds of stories that get told. Culturally, the stakes felt even higher. Hollywood has always been a balance between art and commerce, risk and repetition. Netflix disrupted that balance once before by changing how television was consumed. This time, critics feared it could reshape cinema itself. If a streaming-first mindset dominated Warner Brothers' vast IP, theatrical releases could shrink or disappear, altering the movie-going experience entirely. As debates intensified, one thing became clear. This wasn't just about Netflix and Warner Brothers. It was about the future structure of entertainment. Who controls stories? Who decides how they're distributed? And what happens when technology companies absorb cultural institutions that once stood independently? These questions lingered as another unexpected player entered the scene, turning an already tense situation into an outright corporate battle. The situation escalated dramatically when Paramount Skydance entered the picture with a hostile takeover bid. Unlike friendly acquisitions, a hostile bid bypasses a company's leadership and appeals directly to shareholders. It's an aggressive move, often seen as a last resort, and it instantly raised the stakes around Warner Brothers. Paramount's offer wasn't subtle. It promised more cash, fewer conditions, and immediate certainty. For shareholders focused purely on short-term financial gain, the numbers were hard to ignore. Behind this bid stood the Ellison family, a name already deeply embedded in the technology and media landscape. With ownership ties to Oracle and growing influence across global tech infrastructure, their involvement added another layer of concern. The bid was also backed by international financing, including Middle Eastern sovereign wealth funds. This triggered questions far beyond entertainment. When foreign capital enters legacy media institutions, especially those connected to news organizations, regulators and policymakers tend to take notice. Warner Brothers board reacted forcefully. In a detailed response, they rejected Paramount's proposal, citing concerns over organization, financing stability, and governance. The language used was unusually sharp, suggesting not just disagreement, but distrust. They accused Paramount of submitting incomplete documentation and missing deadlines, implying a lack of seriousness behind the offer. For a board tasked with protecting long-term value, uncertainty can be more dangerous than a lower price. But the most controversial revelation involved allegations that Warner Brothers CEO had been offered a massive compensation package if the Paramount deal succeeded, while the CEO rejected the proposal, calling it inappropriate. The mere suggestion fueled public outrage. It reinforced the perception that this wasn't just a business negotiation, but a power struggle shaped by wealth, influence, and ambition. Despite the board's rejection, the story didn't end there. In a hostile takeover, the final decision lies with shareholders. That meant months of uncertainty ahead. Two competing visions now stood in front of them. Netflix's structured, equity-based future versus Paramount's cash-heavy, traditional consolidation approach. And whichever path they chose would ripple far beyond balance sheets. As the corporate battle unfolded, regulators began paying closer attention. This was no longer just a merger between entertainment companies. It was a potential reshaping of global media power. Netflix already dominated the streaming landscape, with hundreds of millions of subscribers worldwide. Adding Warner Brothers' vast library of intellectual property would give it unprecedented control over what content is produced, distributed, and prioritized. Antitrust authorities exist to prevent exactly this kind of concentration. Their concern isn't creativity or storytelling, it's market power. If one company controls too much content, competition suffers. Smaller studios struggle to license material. Independent creators lose bargaining power, and consumers eventually face higher prices and fewer genuine choices. Regulators in the US and abroad understood that approving such a deal could set a powerful precedent. Industry voices echoed these concerns. Analysts warned that a combined Netflix-Warner entity could dominate both production and distribution, squeezing rivals out of the market. Streaming services already operate on thin margins, and competing with a content giant would become increasingly difficult. Over time, diversity in storytelling could shrink, replaced by data-driven decisions optimized for scale rather than originality. Creative unions were especially vocal. Writers, directors, and production crews feared that consolidation would lead to job losses and downward pressure on wages. When fewer buyers exist for creative work, negotiating power shifts dramatically. What once was a competitive marketplace becomes centralized, and creativity risks being treated as a cost center rather than a cultural asset. Netflix, however, remained confident. Public statements emphasized compliance, cooperation, and belief in regulatory approval. From their perspective, the deal represented evolution, not domination. But confidence doesn't erase concern. History shows that once power consolidates, reversing it becomes nearly impossible. That reality weighed heavily as governments evaluated the potential long-term consequences. Beyond economics and regulation, there was a deeper cultural anxiety surrounding the deal. Hollywood isn't just an industry. It's a storytelling tradition shaped by theaters, premieres, and shared experiences. Streaming already changed how stories are consumed, shifting audiences from cinemas to living rooms. The fear now was that a Netflix-led Warner Brothers would accelerate that shift beyond repair. Netflix executives had openly questioned the relevance of traditional theatrical releases. From a business standpoint, their logic was clear. Streaming first distribution reduces costs and maximizes control. But for filmmakers, theaters represent more than revenue. They symbolize scale, immersion, and artistic intention. Removing that pathway could fundamentally change how films are made and valued. Producers warned that Netflix's incentives didn't align with cinema preservation. Time spent watching a movie in a theater doesn't benefit a streaming platform. That creates a structural conflict. If Warner Brothers' iconic franchises moved exclusively to streaming, cinemas would lose not just content, but cultural relevance. The ripple effect would touch local theaters, international film markets, and even how future generations experience movies. There was also uncertainty about creative direction. Iconic franchises carry expectations built over decades. Under a data-driven model, risk-taking may decrease. Projects would be judged less on artistic vision and more on predicted engagement metrics. While this approach can produce consistent results, it can also discourage experimentation. The question wasn't whether Netflix could manage these franchises, but whether it could nurture them. At its core, the debate reflected a broader tension between technology and tradition. Netflix represented efficiency, scale, and optimization. Warner Brothers represented heritage, craftsmanship, and legacy. Bringing them together could either spark a renaissance or accelerate homogenization. No one could say for sure. As shareholders prepared to decide, one truth became unavoidable. Regardless of who won, the entertainment landscape would never return to what it once was. The outcome would influence how stories are funded, where they are seen, and who ultimately controls the narratives shaping modern culture. As the Netflix-Warner Brothers merger unfolded, attention turned to the broader implications for Hollywood's creative ecosystem. On one hand, consolidating a massive library of intellectual property under one roof promised opportunities. Franchises like Harry Potter, Game of Thrones, DC Comics, and The Matrix suddenly had the potential for new adaptations, spin-offs, and cross-platform storytelling. Netflix's data-driven approach could allow content creators to better understand audience preferences, optimizing production choices in unprecedented ways. For fans, this meant the possibility of richer, more personalized entertainment experiences that spanned decades of beloved narratives. Yet, the excitement was tempered by apprehension. Centralizing control over such iconic IP meant fewer decision-makers had the power to greenlight the ambitious, risky projects. Historically, studios functioned as a checks and balances system, balancing corporate priorities against creative freedom. A Netflix-centric model, driven primarily by subscriber growth and algorithmic predictions, could inadvertently stifle originality. For every breakthrough series or film, there was the risk of dozens of promising projects being shelved simply because data suggested modest engagement. Investor influence also introduced subtle pressures. The emphasis on shareholder value could shift priorities from creative integrity to profit maximization. Netflix had already demonstrated this with subscription price increases, reduced password sharing, and advertising tiers. With Warner Brothers' vast assets integrated, the stakes were higher. Cost-cutting measures, operational streamlining, and potential layoffs loomed over employees who had spent decades nurturing franchises. Each decision, while financially sound, carried cultural consequences. International markets added another layer of complexity. Warner Brothers content resonates globally, from North America to Europe and Asia. Netflix's reach amplified the scale of influence, but also concentrated power. Decisions about what content to prioritize, which franchises to revive, and which audiences to target now rested with a single entity. The merger became not just a business story, but a cultural pivot with global ramifications. Finally, the public reaction reflected ambivalence. Fans eagerly anticipated new series and cinematic projects, but feared the homogenization of stories. Critics worried about the decline of traditional theater experiences and the erosion of creative experimentation. Economically, the merger promised efficiency, but culturally, it challenged the foundations of what had long been an industry committed to storytelling innovation. The Paramount counterbid, despite being rejected, illustrated the fragile balance of power in modern media. Corporate rivalry in this context isn't just about money. It's about influence, legacy, and vision. Paramount's aggressive cash-focused offer contrasted sharply with Netflix's structured equity model, emphasizing long-term growth and integration. While the Ellison family's backing brought immense financial weight, questions about governance, foreign influence, and strategy ultimately weakened their position. The Warner Brothers board's detailed response highlighted these concerns, demonstrating that mergers are as much about trust and operational clarity as they are about valuation. This tension mirrored broader industry dynamics. Big tech's increasing dominance over creative media challenged traditional Hollywood practices. Decisions that once involved complex negotiations among studios, distributors, and theaters were now increasingly dictated by algorithms and data analytics. The Netflix-Warner merger was, in essence, a microcosm of this global shift, reflecting how technology companies are reshaping entire cultural landscapes. Moreover, the merger underscored the inherent conflict between short-term financial gain and long-term cultural stewardship. Shareholders seek immediate returns. Studios traditionally balance profit with legacy. As Netflix integrated Warner Brothers' portfolio, maintaining that balance became a delicate exercise. Every strategic decision, what franchises to invest in, which releases to prioritize, and how to market content, had to navigate this dual mandate. Regulatory scrutiny intensified these pressures. Antitrust laws exist to prevent market concentration, ensuring competition, diversity, and consumer protection. Netflix's combined influence raised concerns over pricing, access, and create replaced by algorithmic projections and cost-based decisions. Simultaneously, audiences stood to gain and lose. On one hand, subscription holders would have unparalleled access to legendary franchises, cinematic universes, and award-winning content. On the other hand, a monopolized platform might eventually limit diversity. Smaller streaming services and independent productions could struggle to find an audience, narrowing the scope of cultural expression. Choice, ironically, might initially expand, but later contract under market dominance. The broader cinematic experience was also at stake. Netflix's track record indicated a preference for direct-to-streaming releases, bypassing traditional theaters. While convenient for subscribers, this threatened the communal aspect of moviegoing, a hallmark of Hollywood's identity. Premieres, festival circuits, and theater-first releases faced potential marginalization. The merger had the power not just to reshape content production, but to redefine how audiences experience storytelling. Cultural icons like Batman, The Sopranos, Big Bang Theory, and Game of Thrones carried legacies that transcended entertainment. Decisions about their future, whether to reboot, serialize, or adapt, reflected broader societal tastes. Netflix's approach, heavily influenced by global data, could prioritize engagement metrics over creative experimentation. For fans, this created both anticipation and apprehension. The company held the keys to storytelling's past, present, and future, a responsibility few corporations have ever faced. As the final shareholder votes approached, the tension reached a peak. Netflix had the structured approach, historical performance, and global subscriber base. Paramount had aggressive cash offers and established industry clout. But beyond numbers, the battle represented a philosophical divide. The evolution of media in the digital age versus the preservation of traditional structures. Whichever outcome emerged, it would set a precedent for how creative industries, tech giants, and audiences interact for years to come. For consumers, the implications were clear, yet paradoxical. Access to content would expand in the short term, but pricing, advertising, and content diversity remained uncertain. For creative professionals, career paths and project viability faced new pressures. And for regulators, the merger tested the limits of antitrust frameworks in a world where digital platforms increasingly dominate cultural production. Yet, there remained potential for positive transformation. Netflix, by infusing capital, technical innovation, and global distribution into Warner Brothers, could breathe new life into franchises, support ambitious storytelling, and reimagine cinematic universes. Risky original projects might find protection under a company less beholden to immediate box office returns. In the best-case scenario, the merger could foster a renaissance of creativity and access. Ultimately, the Netflix-Warner Brothers story represents more than a corporate transaction. It is a lens through which to observe the shifting dynamics of power, culture, and technology. It raises fundamental questions. Who decides what stories are told? How are audiences served? And how will legacy institutions adapt to survive in a digital-first era? As the dust settles, one truth is undeniable. Entertainment as we know it will never be the same. For viewers, the message is simple. Subscribe, stay informed, and witness the evolution of storytelling unfold. Because in this rapidly changing landscape, understanding these shifts is as important as the stories themselves.